Another exciting segment here on the Professional Edge: investment portfolio concerns. With the recent invasion of Iran, we have some volatility within the stock market. And yes, as a listener here in the Professional Edge, I hope that brings to light that the market is volatile. And when oil jumps to $118 a barrel, drops down by the largest drop in history the same day, well, that indicates that things are volatile and everything does not go up in a straight line. So what we're talking about is why you need to be concerned with protecting your principal within your investment portfolio, and what strategies are there available to you as a listener here on the Professional Edge. Why is principal protection so important? Well, if we lose our principal, then we can't really gain any return on our investment. So if we have $1 million and the market has a 50% correction, well, then now we only have $500,000 left to earn a rate of return. So a 10% return on $500,000 is 50 grand versus a 10% return on $1 million is $100,000, 50% less, obviously. So when you say, all right, what do I need to do to protect my principal? Well, the number one thing is what offers a true guarantee of your principal. A lot of you go, okay, I put my money in my savings account. I get very little interest because the Fed has reduced interest rates, so the banks don't need to pay you because it's FDIC insured. So therefore, your investment or your savings of your principal in that savings account is receiving a very low rate of interest. It's FDIC insured, so therefore that risk of loss is very minimal. So therefore they don't have to pay a very high rate of return on that interest because it is safe. So there is a difference between true guarantees and us risk mitigating on the loss of your principal. So a true guarantee would be that FDIC insurance. You put your $100,000 in your savings account, it's FDIC insured, and you're probably getting less than 0.25%. Now, what are some risk mitigation tools? Well, those are things that our clients at estate management counselors utilize within their portfolio. And you as a listener here on the Professional Edge, check the box and see if these are within your portfolio as well. So there's a difference between avoiding loss and reducing loss, okay? How would we avoid loss? Well, we wouldn't make any investment. So therefore, we take zero risk. Having a savings account is zero risk. What about a certificate of deposit? Well, that's a FDIC insured instrument as well, if we stay underneath the account minimum. And therefore, again, it's FDIC insured. They don't have to pay a high rate of interest on that because it's very safe. Some of our listeners have those. They had them when you were getting 5.25% on a CD. Now we have this reinvestment risk because the CD is maturing and they're not offering a 5.25% return on a CD anymore. It's 3 or under 3% on that CD. So that's one safe mechanism that protects our principal. The other mechanism that we've talked about here on the Professional Edge is a fixed annuity. That is a contract with an insurance company. So we got to look to the claims paying ability of that insurance company. And you can have, let's say, a 3-year fixed annuity, which says, here's our agreement for 3 years. We're in the contract, it says specifically what interest rate they're going to pay. And then at the end of the term, you're going to get your principal back and you're going to get your interest credited to your withdrawal balance. And again, it's based on the claims paying ability of the insurance company. But, insurance companies that have been around, let's say, 100 years, and they're rated properly by S&P, Moody's, as being a top drawer insurance company, then probably a very minimal amount of risk on not having your principal protected. So there's the other way of, protecting your principal. And again, it's a contract with an insurance company. Almost all insurance companies do these. And if that's suitable for you on avoiding any loss, well, then you're also not going to get that great of return. So that's another thing that we look at. Then we look at your investment portfolio, okay? So you're in the market, you're invested, you have this diversified, you own a bunch of mutual funds, stocks, bonds, all those good things. Well, we all know that a mutual fund, let's say we invest 10 grand and it's now worth 25 grand because we've been invested the past 3 years. The market's been great, but there is nothing in that strategy of just owning that position that is going to protect your principal on where it has grown to. So our 10 became 25. Well, that 25 is there. It's only on paper. It's a realized gain. Yes, your net worth has went up by that $15,000, but it is not in there. It is not locked in. So how can you lock in that? And you say, well, I don't want to sell it. That's one way to lock it in. But if you sell it, it may create a taxable transaction inside an after-tax account. We all know as listeners here on the Professional Edge that if we sell that investment for $25,000 inside our IRA or a Roth IRA, then there is no taxable consequence for making that a strategy to protect your principal. So we actually have to dispose of the investment that went from 10 grand to 25 grand in our example and lock in and capture that $25,000 into a position. Now it's in cash. Now it's not subject to the market fluctuations. So that's one way. If it's in that taxable account, we all know that if you hold it longer than a year and a day, it would be long-term capital gains. And depending on your marginal tax rate, then you would either have 0, 10, or 20% long-term capital gains. So you might not want to do that. So what do? Well, we could also say, you know what? I'm okay. I think the market's going to be a little volatile here during this crisis or just the market in general. The numbers, the earnings season could be here and companies are just missing by, let's say, 1-2%. And all of a sudden, there's a contagion fear that all the companies that are going to report earnings are going to be below expectations. Now the market becomes real volatile. Well, you can actually implement what is known as a stop loss, which basically says it's trading at $100 per share is the stock. And we say, okay, if it fluctuates below 5%, meaning if the market drops greater than 5%, then we automatically have this pending order, which says if it drops 5%, we sell. That's called a stop loss. We can customize that if you're too close to the vest, and I think a 5% drop is probably too close. We could say anywhere from 7 to 8 to 10%. If there's this fluctuation within the market, it's a non-emotional decision. We're not reacting to headlines. So we say 7% drop, boom, we're out. It sells. You're in cash. You are no longer subject to the market risk. So that's another strategy. You got to ask yourself whether you have any of this inside your portfolio. Well, and a lot of people don't have this. They don't use this tool, and it is a financial tool. So, again, it's you understanding what you have done within your portfolio. And if you've not done any of this, then you're not protecting your principal and who's manning the store. So that's where you take the opportunity, give our office a call at 404-250-9798. That number again, 404-250-9798. We either meet down here at the Cunningham Center or we can meet in the office up in Atlanta, Georgia. Or if you're listening to this in another state, let's say the great state of Idaho, then we can have a Zoom call and discuss what strategy might make the most financial sense for you so you don't run out of money before you run out of time. So with that, that's one way to protect your portfolio on that investment portfolio concerns. So The con on this stop loss is it may fluctuate down to 6%, and you're still in, and your account is down 6%. So there's that. If we have this stop loss in a taxable account and it stops out, meaning it sells, then we got to figure out what that gain is going to be within your portfolio and pay the Internal Revenue Service some tax. So that's sort of a downside of that. So moving on the investment portfolio concerns. Well, we have this vehicle called Boomer's Candy. That's what they refer to it in the financial articles. And it's called a buffered ETF. So everyone's heard of an ETF. It's similar to a mutual fund. It is not one company. It is a conglomeration of different companies. So we could have 50 different holdings within this ETF. And we enter into this agreement, which basically says a 1-year term. And I'm trying to simplify it so you can follow along. So we have a 1-year term, and it says basically if it goes, let's say the S&P 500 index, if it goes up 10%, you get all 10%. But if it exceeds 10% rate of return, you don't get any more of that. So it's a capped upside. So anything over 10 in this example, you don't get. But on the downside, you could have a 20% buffer. So if the market, the S&P 500, goes down 15% for the year, guess what? You're at zero. You didn't participate in any of that downside loss. So you're buffered against that loss. Okay, what's the pros and cons? Well, the pros are you're buffered for that 20% loss in our example. But if it goes down 30%, then you're going to participate in that next 10%. So it doesn't buffer the whole thing away. Now, you could set it at 10%, it could be 20%, and that's the good thing. The bad thing is, well, if the market has a tremendous run and it goes up 20%, the way in our example, you're buffered, meaning you stop participating at a 10% positive. So anything over 10% you don't get, but if you're okay with this, what I call the range of potential gain and protection of the loss, then a buffered ETF may make financial sense for you. To evaluate your own personal concerns on this, on your investment portfolio concerns, do give our office a call at 404-250-9798. That number again, 404-250-9798. My name's Sean Todd. I appreciate you listening to The Professional Edge. Be sure to share these episodes with your friends via forwarding our podcast link to them. Again, thanks for listening.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Sean Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Sean Todd help you implement an effective estate plan. Call 877-654-9798 today. As a tax attorney, CPA for over 15 years, Sean Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. Sean has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.